I was having coffee with my financial advisor last Tuesday when he said something that made my blood run cold. What's coming in 2026 will make 2008 look like a minor correction. At first, I thought he was being dramatic, but then he showed me the data. Global debt has reached $315 trillion. That's 335% of global GDP, the highest in recorded history. During the Great Depression, debt was only 260% of GDP, and we all know how that ended. But here's what's truly terrifying. We're not just facing one crisis, we're facing 5 simultaneous economic time bombs that are all set to detonate in 2026, and almost nobody is talking about it. The commercial real estate market is collapsing with $1.5 trillion in loans coming due. The largest wave of corporate debt maturity in history is hitting. Pension funds are $7 trillion underfunded. The derivatives market has swollen to over $600 trillion, creating systemic risk that dwarfs anything we've seen before. And geopolitical tensions are threatening the dollar's reserve currency status. I hope you're doing well, and if you want to protect yourself from what's coming, please subscribe to my channel and hit the bell icon, because I'm going to break down exactly what's happening, and more importantly, what you can do about it right now. Let me start by painting you a picture of what economic destruction really looks like. During the Great Depression, unemployment hit 25%, but that number doesn't tell the whole story. Families lost everything. The stock market crashed 89% from peak to trough. 9,000 banks failed, wiping out people's life savings because deposit insurance didn't exist yet. Farmers were forced to burn their crops because prices had fallen so low it cost more to harvest than they could sell for. Bread lines stretched for blocks in every major city. Families were torn apart as fathers left home searching for work that didn't exist. Children went hungry. People lived in shanty towns made of cardboard and scrap metal that they mockingly called Hoovervilles. The psychological trauma lasted for generations, creating an entire generation that never trusted banks again, that saved every penny, that lived in constant fear of losing everything because they had already lost everything once. Now imagine something worse. Imagine the Great Depression happening in our modern, interconnected, digitized, debt-fueled economy, where everything is leveraged to the maximum and one domino falling can trigger a cascade that circles the globe in milliseconds. The first-time bomb is commercial real estate, and it's already started exploding. Since the pandemic, office occupancy rates have plummeted to an average of just 50% in major cities. Companies realized they don't need massive office spaces when employees can work from home. But here's the problem. There's approximately $1.5 trillion in commercial real estate loans coming due between 2024 and 2026, and the properties backing those loans are now worth 30% to 50% less than when the loans were originated. Banks are facing a simple math problem with catastrophic implications. A company took out a $10 million loan in 2019 to buy an office building, but that building is now worth only $6 million because nobody wants office space anymore. The loan comes due in 2026, and the company can't refinance because no bank will lend $10 million on a $6 million asset. So what happens? Default. But it's not just one building, it's thousands of buildings across every major city in America and Europe. Small and regional banks hold a disproportionate amount of these commercial real estate loans, which means we're looking at a wave of bank failures that could make 2008 look tame. Remember, in 2008, we saw 465 banks fail in the United States. The FDIC's Deposit Insurance Fund, which is supposed to protect depositors, currently has about $125 billion in it. That sounds like a lot until you realize that's only about 1.27% of insured deposits. If we see a cascade of bank failures, that fund will be depleted almost immediately, and then what? Government bailouts, which brings us to problem number 2. Government debt has reached levels that were previously thought impossible. The United States national debt just crossed $36 trillion and is growing by over $1 trillion every 100 days. Japan's debt is 264% of GDP. Italy is at 144%. Greece, which already went through a debt crisis, is still at 172%. But here's what makes 2026 different. Interest rates have risen dramatically. For over a decade, governments could borrow money essentially for free because interest rates were near zero. They became addicted to cheap debt, spending far beyond their means because there was no immediate consequence. But now interest rates have normalized, and suddenly the interest payments on all that debt have become crushing. The United States government is now spending over $1 trillion per year just on interest payments, more than it spends on defense, more than it spends on Medicare. That's money that produces nothing, builds nothing, helps no one. It's just gone, transferred to bondholders. And as more debt comes due and needs to be refinanced at higher rates, those interest payments will explode even further. This creates a death spiral. Governments need to borrow more money to pay the interest on the money they've already borrowed, which increases the debt, which increases future interest payments, which requires more borrowing. Eventually, bond markets lose confidence, interest rates spike even higher, and the whole system collapses. We've seen this movie before in Greece, in Argentina, in Zimbabwe, but never in the world's largest economies all at the same time. The third time, bomb is corporate debt, and it's even more dangerous than government debt because corporations can't print money. During the era of near-zero interest rates, corporations went on a borrowing binge. They borrowed money not to invest in productive capacity, but to buy back their own stock, to pay dividends, to make acquisitions at inflated prices. It was financial engineering instead of real engineering. Now we're facing the largest corporate debt maturity wall in history. Over $5 trillion in corporate bonds will mature between 2025 and 2027. Companies that borrowed at 2% interest rates will need to refinance at 6% or 7% or higher. Many simply won't be able to afford it. Their cash flows can't support triple the interest expense. So what happens? Defaults. But corporate defaults don't happen in isolation. When a major corporation defaults, it triggers credit default swaps, which are essentially insurance policies that banks and investors bought to protect against default. The problem is that the total notional value of credit default swaps is in the tens of trillions of dollars, and nobody really knows who owes what to whom. It's a web of interconnected obligations that's so complex, even the banks don't fully understand it. When one major default triggers a cascade of credit default swap payments, we could see major financial institutions become insolvent overnight, just like we saw with Bear Stearns and Lehman Brothers in 2008, except this time it could be multiple institutions simultaneously. Now let's talk about the pension crisis, which might be the cruelest bomb of all because it's going to devastate the people who did everything right. Public pension funds in the United States are underfunded by approximately $7 trillion. That means they've promised benefits to retirees that they simply don't have the money to pay. How did this happen? For decades, pension fund managers assumed they could earn 7% or 8% annual returns on their investments. They made promises to workers based on those assumptions. But with interest rates near zero for so long and stock market valuations at extreme levels, those returns became impossible to achieve. Now the math doesn't work. The pension funds don't have enough money to pay what they've promised, and there's no way to fix it without either drastically cutting benefits or massive taxpayer bailouts. Teachers who worked for 30 years expecting a pension will see their payments cut by 30%, 40%, maybe 50%. Police officers, firefighters, government workers, all facing the same reality. And because these are public pensions, the burden falls on taxpayers, which means higher taxes on everyone else, just as the economy is collapsing. Private pensions face similar problems. Corporations have been shifting away from defined benefit pensions to 401ks, which transfers the risk to workers, but many companies still have legacy pension obligations they can't meet. When these companies fail, their pension obligations get transferred to the Pension Benefit Guaranty Corporation, which is supposed to protect worker pensions, but the PBGC itself is underfunded. We're looking at a situation where millions of retirees who did everything right, who worked hard, who saved responsibly, will see their retirement dreams evaporate. The fifth time bomb is the one that keeps economists awake at night, the derivatives market. The total notional value of derivatives worldwide is estimated at over $600 trillion. To put that in perspective, that's 7 times global GDP. Derivatives are essentially bets on bets on bets, complex financial instruments that are supposed to distribute risk, but actually concentrate it in ways we don't fully understand. Warren Buffett famously called derivatives financial weapons of mass destruction, and he was right. The problem is that derivatives create hidden linkages between financial institutions. Bank A might look perfectly healthy on paper, but if Bank B fails and can't pay on a derivative contract, suddenly Bank A is in trouble too. And if Bank A fails, it triggers problems at banks C, D, and E. It's a house of cards built on quicksand. In 2008, the derivatives market nearly destroyed the global financial system when it became clear that major institutions had sold credit default swaps they couldn't possibly pay if things went wrong. The government stepped in with trillions in bailouts and guarantees, but the derivatives market has only grown larger and more complex since then. When the next crisis hits and derivatives start unwinding, the cascade could be unstoppable. But wait, there's more, and this is where it gets truly frightening. All 5 of these time bombs are interconnected and will amplify each other. When commercial real estate crashes, it causes bank failures. Bank failures cause credit to dry up. Without credit, corporations can't refinance their debt, leading to corporate defaults. Corporate defaults reduce tax revenue and increase unemployment. Lower tax revenue and higher unemployment make government debt unsustainable. Unsustainable government debt causes currency devaluation. Currency devaluation makes imports more expensive, causing inflation. Inflation forces central banks to raise interest rates even higher, which makes all the debt problems even worse. It's a feedback loop of destruction. And we haven't even talked about the geopolitical dimension. The US dollar has been the world's reserve currency since World War II, which gives America enormous economic advantages. We can run massive deficits because the world needs dollars to conduct international trade. But that system is breaking down. China has been systematically working to internationalize the yuan. BRICS nations are creating alternative payment systems. Central banks around the world are buying gold at the fastest pace in decades because they're losing confidence in dollar-based assets. If the dollar loses its reserve currency status, even partially, it would be economically catastrophic for the United States. Suddenly, we couldn't just print money to solve our problems. We'd have to actually pay our debts, and we can't. The adjustment would be brutal: massive inflation, plummeting living standards, social unrest. So why 2026 specifically? Why not 2025 or 2027? Because that's when all these cycles are converging. The commercial real estate loan maturity wall peaks in 2026. The corporate debt maturity wall hits hardest in 2025 to 2027. Pension funds are running out of runway and facing a reckoning they can't postpone any longer. Government debt to GDP ratios are reaching levels historically associated with defaults or severe crises. The derivatives time bomb can go off at any moment, but the stress on the financial system will be greatest when everything else is already in crisis. It's like trying to juggle 5 chainsaws that are all on fire and you're standing on ice and the ice is melting. Eventually, something goes catastrophically wrong, and 2026 is when all the conditions align for that catastrophe. Now, I know what you're thinking. This sounds like doom and gloom, like fear-mongering. You might be thinking that smart people are in charge, that central banks and governments will figure something out, that we've faced crises before and gotten through them. And you're right, that we've faced crises before. But this time truly is different, and here's why. In 2008, central banks had ammunition. They could cut interest rates from 5% to 0. They could launch quantitative easing, creating trillions of dollars out of thin air to buy bonds and prop up asset prices. They could bail out banks because government debt levels were still manageable. It worked, sort of. We avoided a complete collapse, though millions of people still lost their homes and their jobs. But now the ammunition is gone. Interest rates are already elevated and can't go much higher without breaking everything, but they also can't go back to 0 without causing runaway inflation. Government debt is so high that massive new bailouts might cause a sovereign debt crisis. Central bank balance sheets are already bloated with assets they can't sell without crashing markets. The tools that worked in 2008 won't work in 2026. We're out of tricks. Some people point to technology as a savior. AI will boost productivity, they say. Innovation will create new industries and new wealth. And maybe that's true in the long run, over decades. But in the short run, over the next few years, technology can't solve a debt crisis. You can't pay off $315 trillion in global debt with productivity improvements. You can't make a $1.5 trillion commercial real estate hole disappear with innovation. The math doesn't work. The crisis is coming regardless of how many breakthroughs we have in artificial intelligence or quantum computing or biotechnology. So what can you do about it? First, understand that protecting yourself from this crisis is not about getting rich, it's about not getting destroyed. The goal is preservation of wealth, not growth. Cash is usually considered trash in inflationary times, but you need liquidity. Keep enough cash to cover 6 months to a year of expenses, but not in just one bank. Spread it across multiple institutions because bank failures are coming. Consider keeping some physical cash at home because if there's a banking crisis, ATMs might not work and credit cards might not process. Second, get out of debt if you possibly can. Debt was great when interest rates were low, but now debt is a millstone around your neck. Pay off credit cards, pay off car loans, even consider paying down your mortgage if you can. The people who get destroyed in economic crises are the ones who are over-leveraged. When income drops and assets fall in value, debt becomes crushing. Third, own hard assets. Real estate can be good if you buy it right and in the right locations, but avoid commercial real estate like the plague. Productive land, farmland, things that generate real value regardless of what the financial system does. Gold and silver have been wealth preservation tools for thousands of years. They're not about getting rich. They're about maintaining purchasing power when currencies fail. Fourth, develop skills that will be valuable in any economy. If you rely on a single employer in a fragile industry, you're vulnerable. Learn skills that people will need regardless of economic conditions. Medical skills, trade skills like plumbing or electrical work, farming, anything that produces real value rather than just shuffling paper. Fifth, build community. In hard times, the people who survive and even thrive are the ones with strong networks of family, friends, and neighbors. Get to know your neighbors now. Build relationships. Create mutual aid networks. When the system fails, human connections become invaluable. Look at what happened during the Great Depression to understand what survival looked like. The people who made it through were the ones who could grow food, fix things, barter, help each other out. The wealthy people who lost everything in the stock market crash, many of them never recovered. But the farmers, the tradespeople, the folks with practical skills and community connections, they struggled, but they survived. We need to learn from that. We need to prepare not just financially, but practically and socially. This isn't about becoming a doomsday prepper hiding in a bunker. This is about being realistic about what's coming and taking sensible precautions. You wear a seatbelt not because you plan to crash, but because crashes happen. You have insurance not because you want your house to burn down, but because it might. Preparing for economic crisis is the same principle. You hope it doesn't happen, but you prepare in case it does. The really insidious thing about what's coming is that it will be sold to you as unavoidable, as something that nobody could have predicted, as a black swan event. But it's not. The warning signs are everywhere. The data is clear. The debt is unsustainable. The system is fragile. The time bombs are ticking. The people in power know this, but they're hoping to kick the can down the road a little further to make it someone else's problem. Politicians want to get through the next election. CEOs want to collect their bonuses. Central bankers want to avoid being blamed, so they'll keep pretending everything is fine right up until it's not. By then, it will be too late for most people to prepare. That's why you need to act now while there's still time. One more thing I want to emphasize. This is not about politics. This is not a left-wing or right-wing issue. Both parties have been complicit in creating these problems. Republicans and Democrats alike have voted for deficit spending, for bailouts, for policies that inflate asset bubbles and create systemic risk. The system is broken, regardless of who's in charge, because the incentives are broken. Politicians get rewarded for spending money and punished for fiscal responsibility. That's not going to change. So don't wait for political solutions. Don't wait for someone to fix this. Take responsibility for your own financial future. The storm is coming. You can see it on the horizon. The question is whether you're going to prepare or whether you're going to hope for the best and end up with the rest. I've laid out exactly what's happening and why 2026 is the convergence point. I've explained the mechanisms of destruction. Now it's up to you to decide what to do with this information. Protect yourself, protect your family, and prepare for what's coming. Because whether we want to believe it or not, 2026 is going to rewrite economic history, and most people will be caught completely unprepared.